Welcome to the Morrison Report. Hosted by Deval Morrison, sales representative for Bosley Real Estate Limited Brokerage. Ms. Morrison has co-authored the best-selling book, Success Today, with Brian Tracy, and has been interviewed on NBC, ABC, and CBS affiliates by Bob Guinea from The Bachelor. Deval, a real estate investor, has spoken to many attendees at her real estate seminars and is currently ranked in the top 5% of agents in her brokerage. Join me in welcoming your host, Deval Morrison.
Welcome to the show today, Jow Sammut. He is a mortgage broker with Mortgage Architects, and I wanted him to talk to us a little bit more about financing, renovation financing, construction financing. Jow, tell us a little bit about yourself.
Hi, Deval. Thanks very much for having me. Again, my name is Jow Sammut. I'm one of the lead planner mortgage brokers with Mortgage Architects, and we actually started the company 10 years ago and built it into one of Canada's largest brokerage firms. As of January this year, we did a merger with a very large company called Dominion Lending Centers, which has now put us in a position whereby we are Canada's largest brokerage firm, so the largest mortgage originators in Canada, which is quite a position to hold and quite something that we're quite proud of. I've been in the business 25 years. I personally do approximately $150 million of mortgage business a year, and love what I do. So it's every day is a challenge, every day is a new day, and every deal is exciting, especially nowadays.
Perfect. That's great, Jow. Can you tell us a little bit about renovations, and if someone's looking to do renovations in their home where they currently live, how would they go about trying to finance those renos?
There are a number of different ways. The majority of people out there will use a line of credit to facilitate renovation costs. There are a number of different programs available for new homeowners as well as for existing homeowners that are looking to refinance. One of the tools that we would do for somebody that is, in fact, owning a home currently and they just want to do a renovation, whether it be finishing a basement, adding a second floor, making the back of the house larger, what we would do is a line of credit. We would arrange a line of credit facility for them on that house that they then have access to. So that way they can draw on the line of credit as the expenses of the renovation are coming up. And then once all is said and done and they've spent all the money they're about to spend or needed to spend for the renovation, we then can look at putting it into a different type of facility to lock it in for them, to give them more certainty with rates and terms and things like that. As far as new homeowners, there are programs for individuals that have less than 20% down. There's a phenomenal program out there called Purchase Plus Improvements. And what that allows an individual to do is to purchase a home. They can finance theoretically up to 10% of the purchase price in renovation money through and form part of the mortgage. So let's say, take for an example, a $600,000 purchase.
Okay.
They can finance up to $60,000 of renovation money, and that then just gets added to the mortgage and it's amortized over time. So it gives an individual the opportunity to buy a property and incorporate the renovation money into their mortgage, so that way they're able to then finish the house to their specifications and end up with a fully renovated home or a nicely renovated home right after closing. So it's a beautiful program.
So tell me something then, because I mean, a lot of the housing stock in Toronto is quite old. Most of the houses are about 100 years old. So if someone's going and thinking that they're going to do a Purchase Plus improvement, you mentioned it's approximately 10%. So it's sort of sounding like it could be a bathroom or a kitchen reno versus putting on a big addition. Would that be correct?
Precisely. It's more designed for the individual that's going to do windows, doors, floors. That's the terminology I always use. Windows, doors, floors, roofing, kitchen countertops, bathroom countertops, things like that. That particular program is not designed for those individuals that are buying and are going to do the major reno. That's where you get into the line of credit that we had talked about earlier. The Purchase Plus Improvement Program is more, again, of a smaller type build or a smaller type reno. The line of credit, or in fact, construction financing, is designed for somebody that is going to be doing something to drastically improve the value of their home and drastically or dramatically improve their living space. So they are two completely separate things, but both are available to either first-time home buyers or existing homeowners.
Just one question. If someone wanted to do the construction financing, do they put 5% down, 20% down? How does that work?
Ideally, it's 20%. And the reason I say that is because banks, generally speaking, unless you get into a construction type mortgage, they don't like to know that you're doing excessive renovations to the home. So if you're going to do it the right way, the honest way, the above board way, what you in fact do then is you're going to a lender and you're applying for actual construction financing. In that case, you need 20% down. And the way that program would work is you would have a lender that would give you, say, 80% of the land value. So if you have a home that's worth $800,000, they're going to give you 80% of that as just a mortgage, which would be $640,000.
Wow.
And then they will finance up to 80% of your renovation money. And they will give that to you in certain draws during the time of construction. So you could theoretically, if you had, an $800,000 house, you'd have a $640,000 mortgage on it. If you had an $800,000 reno, you would then be eligible for another $640,000 of construction financing. So you could quite easily finance, would that be $1.28 million of an all-in price of, say, $1.6 million, but an end value of probably closer to $2 million if that were the numbers that would work out for you. But again, we could get you 80% of the acquisition of the property, or again, for that homeowner that currently owns, we get them 80% of the present value, and then we can get them 80% of the construction cost as well at very, very attractive rates, by the way.
And so walk me through the steps. So whether somebody is doing that line of credit route or whether they're going through with the construction financing or even with the purchase plus improvements, does an appraiser need to go out first to sort of figure out what the value of the house is?
Very much so. So again, talking about an existing homeowner, we would have to assess the present day value of the home, and we would also then need to assess what they call the upon completion value of the home would be. So after all renovations are done, all the dust is settled, what would the value of that house be based on the plans that the homeowner has been able to provide to the appraiser? So we would do a before and an after, right at the beginning. And then when the project is complete, they would send it to the appraiser up just to make sure that their initial assumptions of value were in fact accurate.
Okay.
So appraisals would play a very important part of the entire transaction, start to finish, in the middle, anytime that a draw is being made.
Yeah.
So anytime that the homeowner is drawing down on the construction financing available, most often you would need an appraiser to go out there to determine the work that was done and the present value of the home at the time they're going to advance more money.
Got it. So now, what kinds of plans does someone need to submit to their bank for construction financing? Is that similar to the same plans they would submit to the city for building permits, or is there something a little bit different?
No, very much. What we would need would be a construction budget. So we would need to know what the individual intends on spending on the renovation. We would need a contractor's quote and some preliminary drawings to give some idea as to what scope of work is being done to the home. Those drawings, those quotes, and all of that material would then form part of the calculation that the appraiser is going to make to then determine the end value of that home. But the lender would want to see that this is a well thought out project, and it's not somebody that's just asking for money and they're going to build on the fly. They're going to have thought it out. They're going to have to go through whatever committees they need to get to the point where they're able to build or are able to construct. And all of that information needs to be provided to the lender before the lender will advance construction funds.
So does that mean, because you said that the construction companies or the contractor would provide a quote, does that mean they even need to have a quote for every last tile and every last floorboard in order to give it to the bank?
I would imagine, not necessarily. I would imagine that an overall high-level scope of the work that's being done by the general contractor is quite satisfactory or quite sufficient for what the lender needs to do.
Okay.
You have to keep in mind that if it's real construction financing, the lender is going to be sending appraisers out intermittently throughout the project.
Mm-hmm.
So by the appraiser going out, they will be able to determine on behalf of the lender how much work has been completed to date and how much is yet to be done. And it's during those different visits that the appraiser would determine perhaps whether or not finishings had changed throughout the process, whether or not the homeowner had changed the plan or the design.
Right.
That would then help everybody determine the level of completion that they're at that particular stage.
Wow.
So the nitty-gritty tiling and appliances or hardware within the home, that can all be done as you're nearing the end of the project. That doesn't necessarily have to form part of the finite details of the actual initial quotes.
Got it. Wow, it sounds kind of onerous and a little complicated now.
You know what? It's not for the faint of heart. If you're taking on the project of renovating or doing a major build on a home,
mm-hmm.
you need to be prepared for all of these, I won't call them roadblocks or hurdles, but steps. They're part of the process. And if you're not the type of person that has the time, the know-how, or the desire to go through some of this red tape, then it's really not something that you should take on unless you've paired up or partnered up with a very good general contractor who can take the weight off of your shoulders, and then all you need to do is worry about qualifying for the financing. As a homeowner, or the majority of homeowners out there, they're not equipped, whether it be from a knowledge base or emotionally, to be able to go through this process and deal with all the different trades throughout. So again, it's not for the faint of heart. It's something that you have to have thought out and be very, very comfortable with the fact that you are taking on a major step, a major build.
Wow. And so if someone was just, if we go back to the scenario where somebody owns their house already and they're just looking to do some renos, I guess the bank, again, same thing, would sort of send out an appraiser to figure out how much of a line of credit to give them. Would that be right?
Precisely. So again, let's take this number, $800,000. If somebody had an $800,000 home, they are eligible to take out up to 80% in financing against that home, which would be, again, $640,000. That $640,000 then can be made up of a fixed term mortgage if they happen to have a mortgage on the property, and then the balance can be done again to $640,000 as a line of credit. And that line of credit then can be drawn down as they go through their own renovation. They can manage it if it's a smaller type renovation, as we're talking here.
Yep.
They can manage it a lot easier if they have access to the funds, and those funds can be made available to them through a line of credit.
And so once they're completed their project, does the bank come back with an appraiser to say, okay, your house is worth, let's say, as you said,
No, not at that point, because the line of credit, it was put in place for the homeowner to do with whatever they wanted.
Okay.
They have the ability to renovate. They have the ability to invest. They have the ability with that line of credit to do whatever they want to do with that money. So the bank doesn't need to see what the end product looks like, because their hopes would be, and the client's expectations would be, that they've done nothing but enhance the value of the home based on the original appraisal price.
Of course.
So again, if the original appraisal was $800,000 and these individuals borrowed $200,000 from a line of credit to renovate it, it's pretty safe to assume that $800,000 plus the $200,000 of reno that they put into it, it's going to be worth more than the $1 million that the end product equates to. So the bank is not at all concerned with the end value. That's up to the homeowner to be satisfied with. The only time a bank would ever get involved in a situation like that is if they borrowed their money on the line of credit for the renovation and then perhaps ran out of money, or the project was finished and they needed more money. That's when the bank would have to come back in and reappraise.
Got it. Now, what about if they wanted to refinance it? So if we go back to that example, the person's got an $800,000 house. They've done $200,000 worth of renos, so that's all in their line of credit. And now they just kind of want the bank to come in and appraise it at $1.1 million so that they can pay off that line of credit and roll everything into a mortgage. Does that make sense?
Yeah, it does, but they don't have to do that, because the line of credit, it could be rolled into a mortgage just on its own without having to reappraise. The only reason somebody would want to reappraise is because, again, if we take that exact example, an $800,000 value, they're going to have $640,000 of financing. It just so happens to be in perhaps two different products, a mortgage and a line of credit, totaling $640,000. The house is now worth $1 million or $1.1 million.
Yeah.
They don't need to refinance it to lock that line of credit into a product. They could do that with as simple as a phone call. The only reason why the $1.1 million comes into play is if the client now wants more than the $640,000 that they had, they now want $880,000, which is 80% of $1.1 million. Then we would be able to go back and apply for an additional $240,000 that they then can use for whatever they want.
Got it.
Okay, but to lock in the construction financing, it doesn't need to be reappraised because it's already been appraised or has already been approved based on the original value of that home. And it now just needs to be converted into a product that's more suitable to the client.
Got it. And would you say that a lot of people are taking advantage of things like this right now, whether it's the construction financing or the purchase plus improvements or the lines of credit?
Very much.
Yeah.
Very many people are doing it. Not a day goes by that I don't get a call where somebody is looking at doing either a very small add-on to the high ratio mortgage that they're buying, so the purchase plus improvement, or individuals that are willing to take on the task of a major renovation. And under both scenarios, there are products that are designed specifically for each individual's specific needs. So borrowing money today is pretty interesting because the banks are